Good afternoon, ladies and gentlemen, and thank you for joining us on today's City Business News Now presentation. As a reminder, this session is being recorded. Zoom participants can submit their questions at any time by clicking Q&A at the bottom of your Zoom control bar. Now, please give a warm welcome to Lisa Blossman, publisher of New Orleans City Business.
Thank you, Jenna, and thank you to everyone for joining us today. Welcome to CV Now, the City Business webinar series. This is our midweek recap where we will learn from experts on the state of their industry. Now I'd like to introduce City Business Editor, Natalie Chandler.
Hi, everyone. Thanks for joining us today. And we are talking about what financial statements can tell you about the health of your company. We'll discuss characteristics of the balance sheet, income statement, and statement of cash flows, and how to use these statements to identify potential problems that could be occurring in your business. Our panelist today is Tommy Lane. He's a CPA and partner with Wegman Dezet. Thank you for joining us, Tommy. We look forward to your presentation and what you can tell us in these important areas.
Thanks, Natalie. All right, I'm going to share my screen here. So like Natalie mentioned, this is what we're going to talk about, and I'm going to start with kind of just going over real quick some characteristics of the balance sheet, income statement, and cash flow, just in case anybody needs a quick refresher. I don't like to assume that everybody in the room is an accountant. But I know everybody has an interest in financial statements. So then we'll go into some examples and look at some sample financial statements and kind of go over some indicators and things to look for and what they should be telling you. So the balance sheet is the first financial statement that we're going to talk about. It just presents assets, liabilities, and equity at a specific moment in time. It is what I have versus what I owe, essentially. It's current assets, long-term assets. The current assets are expected to be converted into cash within 12 months, such as cash, accounts receivable, and inventory. Then long-term assets, which are generally take longer than 12 months to convert into cash, like fixed assets and other long-term investments. Current liabilities, which are due within 12 months, typically lines of credit, accounts payable, and current portion of debt. And then long-term liabilities, which are due in greater than 12 months. The equity section of the balance sheet shows the net worth of the business at book value. Essentially, it's the sum of the money put into the business, accumulated profits and losses, and money, less any money that has been taken out of the business. The income statement presents revenue and expenses earned and incurred during a period. So the income statement can be for a month, a quarter, or for a year. And it shows net income generated for the period. Statement of equity is going to show changes of equity during a period, month, quarter, or year, and that's going to include capital contributed into the company, income generated during the period, and distributions taken out of the company. Finally, the statement of cash flows shows the cash flow generated during a period, month, quarter, or year. It essentially takes us from income generated during the period and shows the activity that the cash flow activity and ends with ending cash. It shows cash flow from operating activities, which are the general operations of the company, such as includes trade receivables, trade payables, and accrued expenses, things that are incurred over the normal operation of the business. Then it has a section for cash flow from investing activities, which would be areas that we're investing cash, such as fixed asset additions, investment in subsidiaries, other investing activities. Financing activities is the third section of the cash flow, which goes over cash flow from the financing. So it will show advances on loans and lines of credit and repayments on the debt as well. So the first example that we're looking at shows a sample company that is experiencing some growth over the past 3 years. So this is a profit and loss trend analysis. And you can see that this company is growing $3 million in sales a year over the last 3 years. Gross profit has been fairly consistent. It's slipping a little bit as we're increasing our sales. This company is sacrificing our gross profit percentage a little bit, 1% per year. Operating expenses are holding consistent. So that's fantastic. And you have a pre-tax income of $1.4 million for 2020 and after tax $980,000 for 2020. So this is a pretty positive profit and loss for sure. Things are going in the right direction. We're sacrificing gross profit a little bit, but hopefully not too bad. It's something to keep an eye on though. So this is a balance sheet for company A and B, two different companies that are experiencing the exact same profit and loss. So both of these companies have just incurred these 3 years of activities. But company A and B are experiencing this income. They're having very drastic differences in how they're managing the cash flow during this growth period. So the first thing that obviously sticks out is company A has a whole lot more cash than company B does, even though both of them had the same after-tax income of $980,000. So there's a few things that stick out on this balance sheet that explain the difference in the cash. The first one is accounts receivable. So company A has less money tied up in accounts receivable, which tells us that company A is doing a better job of collecting their receivables. The difference here, it's about $200,000. That's really only 2 days of accounts receivable. So company A is on average collecting their receivables 2 days quicker than company B is. Inventory is the next big line item here that shows a huge difference. And company A is a lot more efficient with their inventory management. So company B has a lot more cash tied up in its inventory. So company A, this equates to inventory turns of 8 during the year, and company B is experiencing 7 turns during the year. And we're going to go over some of these calculations later, but company A basically, to sum up, has effectively increased the efficiency of their inventory management to where they're turning it over once more during the course of the year, and that's equated to around $600,000 of additional cash benefit for them. The rest of the balance sheet looks the same until we get to accounts payable, which is the big difference between these companies. So company A is their accounts payables $1.5 million, and company B is just over $1 million. So company B is paying their vendors quicker than company A is. And company A has effectively an extra $500,000 of cash because of their management of accounts payable. And this works out to 16 days average accounts payable for company A and 11 days for company B. Just those few things have resulted in a cash difference of almost $1.4 million. And, some things to keep in mind on that, obviously we want to collect from our customers as quickly as possible. And there's some inherent challenges with that. Inventory, the less inventory that we have to have on hand, the better, but we don't want to sacrifice to where we can't satisfy our customers and we can't service our customers' needs. And accounts payable, we want to keep our vendors happy so that they can take care of us, but we don't necessarily want to pay them quicker than we have to, especially when you get into a position where you're trying to manage cash flow. So you can see the cash flow statement here for company A and B. Both of them have net $980,000 of net income. They both have $150,000 of depreciation, and then we start seeing some of the big differences. We talked about the trend analysis of the profit and loss. These companies are growing $3 million in sales a year. So it's only natural to expect that our accounts receivable is going to increase. Our sales are going up, our accounts receivable are likely to go up as well. But company A had their receivables up $500,000, and company B is not quite as efficient, and their receivables have gone up $746,000. Along the same lines, the inventory is going to have to increase as well. We now have our sales are increasing, so we have more inventory that there's a demand for that we have to supply. So it's only natural that our inventory is going to go up. But company A is doing a much better job because we've only here increased our inventory $250,000, while company B is almost $900,000 higher. Accounts payable, again, as we're growing, your accounts payable are likely to grow as well. But company B, you can see, is much quicker to pay their bills. So their accounts payable is only $19,000 higher than in the prior year. So you can see that A has net cash provided by operating activities of $880,000, and company B has negative cash, so they've got cash used by operating activities. So what this line item tells, this is the operating activities section, and this tells you, okay, if we had no debt to service and we are just operating the company, this is the cash that we would have generated. So A had $980,000 of income, $150,000 of depreciation expense gets added back because it's non-cash, and we have our accounts receivable, inventory, and accounts payable changes that impact how much money we actually have and how much money we've actually spent. So we have $880,000 of positive cash flow from company A from operating activities, which is great. Company B, on the other hand, needs to be mindful of this. They're using cash. So if they continue on this pattern, then they're going to have a significant cash flow problem on their hand that they're already starting to see. So when we go to the rest of the cash flow, we'll see if company A, if this $880,000 is enough, and how big a trouble company B is getting into. So the next section of the cash flow statement is cash used by investing activities. So they both have $50,000 of fixed asset additions. And then we have the financing activities. They both repaid $400,000 of debt during the year. So company A has their $880,000 of cash generated from operating activities, less $50,000 used by investing activities, less $400,000 used by financing activities, for a total net increase in cash of $430,000 for the year. At the beginning of the year, A and B both had $991,000 of cash. At the end of the year, company A is sitting in a good spot at $1.4 million. Meanwhile, company B has burned through almost all of their cash. So obviously, there's significant ramifications for this. Now, the next ones we're going to look at, kind of look at it from a different perspective. One thing to keep in mind is that each of these financial statements, the balance sheet, the income statement, and the cash flow, they kind of have to be looked at as a whole to get the whole picture. So we saw in the previous example how just looking at the profit and loss can sometimes be misleading because company B, if you're just looking at the income statement, company B wouldn't realize that they're about to embark on some serious cash trouble. So now we're going to look at a little bit different angle. We'll have two different companies, X and Y, that have the opposite problem, kind of. So company Y has a bunch of cash, and company X has a little bit of cash on hand. So if the owner of company Y is just focusing on their bank account, then they may have a false sense of security here, considering some other factors. So while Y has a much healthier cash balance, company X has accounts receivable and inventory on hand that, assuming our receivables are good and our inventory is good, and we'll be able to collect our receivables and sell our inventory, company X is going to be better off a year from now than company Y is going to be. On the liabilities and equity side, company Y has had to borrow a little more on the line of credit, and the accounts payable for company X has increased because company X seems to be growing. You can't tell that just looking at the balance sheet, but it seems to be growing. Their receivables are higher, their accounts payable are higher. If you go to the next page, we go to the cash flow statement, and in conjunction with the balance sheet, you can see that company X made $900,000 and company Y only made $50,000. So this will help kind of add some color to the picture. When you factor in both of them had $150,000 of depreciation expense, but company X has $1 million of increase in AR. Their inventory went up $250,000. Their accounts payable went up $500,000. So their net cash provided by operating activities was $300,000. Company Y had $750,000 generated from operating activities, but effectively all that's happened is they made a little bit of money, but their business is shrinking. Their accounts receivable has gone down $500,000, so they're seeing that in their bank account, but eventually that receivable balance is going to become small. And the same with their inventory. Their inventory has gone down $150,000, and it's important to manage your receivables and manage your inventory so they're not higher than they need to be. But in a vacuum, when you're managing your receivables and inventory consistently, the decrease could signify a problem that our sales are falling. So on the next page of the cash flow statement, you can see that company X was able to repay $400,000 of debt. Company Y paid $100,000, but company Y does have a bunch of cash. They can pay down some more debt. But at the end of the year, the key point to take away here is that just because company X, their cash balance is smaller than company Y's, it doesn't really give you the whole picture. Company Y really needs to be aware of the fact that their sales appear to be slipping, and hopefully, they don't have bigger problems ahead. So some things that banks are looking for, are also some things that that we need to be monitoring for our own financial statements. So obviously, income is important. You want the business to be generating a profit and earning income. When you compare that to your historical performance, are we trending up or are we trending down? Liquidity is another thing that needs to be monitored. The easiest way to do that is to look at your current ratio or your working capital, which is just current assets. Working capital is current assets minus current liabilities. So you can pull up the balance sheet and look at your current assets, look at your current liabilities, and real quick, 30 seconds, you can come up with a working capital number. What that really tells you is it shows the company's ability to where the company's cash position is going to be a year from now. If there's $1 million of current assets and $500,000 of current liabilities, if nothing else were to happen, in a year we'd have $500,000 of we would collect our receivables and convert our inventory to cash, we'd have $500,000 after we paid our current liabilities. Cash flow is a huge issue for banks. So it's important if, to keep an eye on that to know what banks are looking at, especially if we're anticipating looking for a loan or, obtaining financing. So the way that a lot of banks look at cash flow is they take your EBITDA, which is net income before interest, taxes, depreciation, and amortization, and they divide that by the current portion of long-term debt. So it basically takes the ability of a company to satisfy its debt service from cash flow generated from the company, and that's what that ratio basically tells the bank. And then the last one is equity, and what that tells the bank is that either the owners are keeping the money in the company or the owners are taking the money out of the company. Now, different industries, there'll be different, expectations. Some companies, just the way that they're structured, the owners are going to be taking the money out. But it's another thing that banks are paying attention to. So some key things to keep in mind for financial health. Again, accounts receivable is, where are we with our accounts receivable? Are we collecting our receivables efficiently? Do we have old receivables? The older receivable gets, the more likely it is to be uncollectible. So, are we doing a good job managing our receivables? And the best way to do that is to calculate days of sales outstanding, which I'll go over that in a second. Inventory. If you have inventory, if inventory is a big part of your business, then it's real important to manage inventory. It can have a big impact on cash flow. And again, we don't, if you carry excess inventory, then it's more likely to become stale or obsolete. Accounts payable. Again, we're trying to balance keeping our vendors happy and possibly taking advantage of early pay discounts with not paying earlier than we have to, and being able to use that cash and balance our cash needs to fund other areas. Gross profit percentage is a key number. We want to make sure that we're getting the gross profit and the profit from our sales that we're expecting and hoping for. If that number is going down, then we're going to have to make up that somewhere else, or it's just going to be a sacrifice for greater sales. So that's certainly something that's important to keep an eye on. Operating expenses, obviously, if operating expenses go up and get out of hand, it's going to have a direct impact on our net income. So when looking at operating expenses, it's important to look at the trend analysis. Where are our operating expenses in the past, and where are they now? Any significant fluctuations should be looked at, and they ought to be looked at dollar value fluctuations as well as percentage fluctuations. And then finally, liquidity and leverage ratios. We talked about the current ratio. That's a liquidity ratio, and a leverage ratio would be debt to equity. Basically, you take total debt and divide it by equity, and it kind of lets you know how much of the assets on hand are financed by outside parties and how much are financed by the owners, which would be the equity portion. So again, some common measurements and ratios. Working capital, again, is current assets minus current liabilities. So we have $4 million of current assets and $3 million of current liabilities. We have $1 million of working capital. That's essentially kind of an excess number. So you certainly want to have a positive working capital. If you have negative working capital, then that should signify that you have a cash crunch pending. The current ratio is, it basically works the same way. It's a ratio. It takes current assets divided by current liabilities. So if it's greater than 1, then that indicates that we have at least the current assets on hand enough to cover our current liabilities. A bank would typically want to see somewhere above 1 for sure. Around 1.5 would be a comfortable margin. Debt to equity, total liabilities divided by total equity. So in this case, $4 million of liabilities, $3 million of equity. That's a ratio of 1.3 to 1. So the higher the ratio here indicates that the owners possibly are not providing enough capital to fund the business. Now, certainly not every business is the same. If companies that have more dependence on assets to provide their revenue, and such as equipment or inventory, generally are going to require more cash, and typically, there may be more debt associated with that. So this ratio is going to be different depending on the industry, but the higher this ratio is, the more it indicates that there's more outside financing. So accounts receivable, again, you should monitor this accounts receivable using the days of sales outstanding. So we talked about what it is. This is the calculation. If you have accounts receivable of 3.5 million and we have average daily sales of 110,000, and the average daily sales would just be the sales for the year divided by 365 days, then your accounts receivable days are 31.8 days. So it's important to start managing this and being aware of what your historical average was to know if we're trending up or trending down. Inventory turnover. Again, if you have inventory, this is a crucial thing to be mindful of. Ideally, you want to turn over your inventory as much as you can, meaning you have less money tied up in your inventory balance. The more times you're turning your inventory, the more efficient you are. Obviously, we do need to manage expectations of our customers, and you don't want to sacrifice sales because you can't you can't service your customers, but you do want to keep an eye on this. And this ratio is calculated with cost of goods sold divided by average inventory. So if our cost of goods sold was 31.5 million and our average inventory was 4 million, then that's 7.9 turns for the year. And the average inventory is generally just whatever the inventory is for the end of the period, whatever the inventory was at the beginning of the year. Accounts payable days is calculated with accounts payable divided by cost of goods sold per day. So if we have $1 million of accounts payable and our cost of goods sold is 31.5, here we're using 360 days. A lot of times banks use 360. If you can use 360 or 365. I would just be consistent with how you're doing it. It comes up with a cost per day of 87,500, which equates to 11.4 days of accounts payable. So that's some significant ratios and calculations and indicators to be mindful of, to kind of monitor potential problems and are we trending in the right direction? Are we trending in the wrong direction? And can be some important indicators. Are there any questions on all of that? I know I kind of covered a good bit. Does anybody have any questions?
Oh, yeah, Tommy, there were 2 questions. Do you have any budget tips for companies to improve financial statements? And what do you think is the most important thing to watch in the P&L?
So budget tips For sure. I think that pretty much every company should have a budget. So that's the first thing is that you should have one. And the best way to put a budget together is to go over your prior historical accounting information and look at your prior financial statements and use that plus your understanding of the changes that you know have happened and what you would expect to happen. But the baseline is your historical performance. Some things are easy. Rent is easy. Your depreciation expense, your CPA can give you that. But you can look at your salaries over the past 3 years and say, oh, we have $1 million of salaries a year. Have we hired more people? Have we hired less people? And you can adjust the number accordingly. The sales obviously is going to be a little bit of a speculation unless you have contracts in place. But a budget and a forecast, it should be, you need to have one so you can monitor whether or not we're exceeding expectations, meeting expectations, or below expectations, and act accordingly. So it's impossible to get it perfect because nobody can predict the future, but it can be very helpful to keep you on track and make sure you're identifying problems and responding timely. So I think the big takeaways would be to make sure that you're doing it and use historical numbers as a baseline and make adjustments that need to be made. And what was the other question?
What do you think is the most important thing to watch in the P&L?
So obviously, sales are critical, and that's it's the first line on the P&L. So our sales meeting our expectations, if not, why? And gross profit is right there with it and should be looked at the same time. Our sales meeting expectations and our gross profits meeting expectations. If either one of those are falling short, we're certainly going to feel it. So that's the most important thing. But again, I would certainly recommend looking at the operating expenses as well, at least the significant line items within operating expenses, and make sure those are in line, because that's easy ways that you can kind of go through and identify some inefficiencies and maybe make some improvements that directly impact the bottom line.
Great. Thank you so much, Tommy, for your time and for this really valuable information you've given us today. We appreciate your help.
Thank you very much for having me.
We have another webinar planned for September 29th at noon, and we will be discussing COVID and legal issues in the workplace, what employers need to know. We'll be talking about whether you should develop mandatory or optional vaccination policies, best practices for putting policies in place, and more. Our panelist is Camille Bryant, a labor and employment attorney with McGlinchey. So we hope you have a great week, and we hope you'll join us September 29th at noon.